You gotta be flipping my flapjacks. Honest stock is making investors just ridiculous sums of money. This stock in the past 1 year is now up 332%. An absolutely historic move, another 25% move here today. We're going to speak in this video here today about honest stock. Is this about it for the move? Are we just getting started? Is there a lot more upside to the stock ahead? Why is the stock going so insane, 332%? I mean, to put that into some reference, right? Everybody obviously always talks about Nvidia stock. Honest stock is blowing away Nvidia's returns over the past year. Nvidia's up 201%, Honest up 331%. The other most talked about stock is Palantir. I believe Palantir is the number one best performing stock in the S&P 500 by a large margin. Look at Palantir. Palantir in the past year is up 208%. Once again, Honest is up 331%. So if you thought Palantir and Nvidia were making investors rich, you ain't seen nothing yet. Okay, Honest is a whole other level. Now, we'll speak about what's going on in regards to Honest here, if I think this is going to continue on, and all those sorts of things here at the top of the video, because I do think it's a very important stock to speak about, given the move that it's had, and it's still only a $6 stock, a 330% plus move, and it's only a $6 stock. So we'll get into that at the beginning of this video. Then I want to react to Shopify. Shopify is now burning hot. This stock's up another 5% here today. Yesterday it was up 20+%. I want to listen to Shopify's president here speak about the business, what he sees coming for this business, and I'll tell you if I think this stock's a great buy now or not. Okay, Elon Musk White House influence is a poker move for the ages, says Dan Ives. I'm looking really forward to reacting to that video in this one. Then I want to react to this video discussing Amazon stock. It's a big position for me, so I want to speak about that one. And then the last one we'll react to is Jim Liebenthal trimming Microsoft. I think that would be an interesting one because we don't talk too much about selling stocks on the channel, so I want to speak about that and kind of when it's time to sell and those sorts of things. Okay. By the way, appreciate everybody joining me as always. All I need from you is one favor only. Hope it's not too much to ask. Smash that like button, hit that like button, make that like button glow. That's all I ask in return for this video here today. Additionally, if you want to be subscribed to the channel, you can subscribe. I don't know how many subscribers we have. All I know is it's an all-time high. So I appreciate y'all for being here as always. Additionally, if you're looking to access all my premium courses, like my Become a Master Stock Market course, my Dividend Investing Mastery, Stock Options Mastery, Millionaire Playbook, access to my private Discord chat, all those sorts of things, that will be the pinned comment down there today. You can fill out an application. We can see if we can get you access to all that. Maybe next week. I believe we're completely booked out for this week, but potentially next week, okay? Alrighty, so let's get into this. What's going on here with Honest? Well, everything has changed forever, and this stock's about to go crazy. Look at this, okay? Revenue went from $86 million to $99 million. So that was up $13 million on a year-over-year basis, right? But cost of revenue only increased $2 million. Okay. So if, technically not even $2 million, less than $2 million, right? So if your cost of revenue is only up $2 million and your revenue is up $13 million, your gross profit's going to go to the moon. And that's exactly what we saw play out here. Gross profit went to $38 million plus from $27 million in the same quarter last year, right? Selling general administrative, they actually brought that number down year over year, which is unbelievable given the fact that the revenue is increasing quite considerably, right? Marketing costs, they did increase that quite a bit, but I gotta say, they got a hell of an ROI on that. They increased marketing costs a lot. $4 million is no small amount when you're talking about a company's, this is a few $100 million market cap when it comes to Honest, right? So when you're talking about spending $13 million in 1 quarter on marketing, that's a lot of money. There's nothing to sneeze at, right? But they increased that about $4 million, but they brought in an additional $13 million of revenue, right? Gross profit was up $11 million plus on a year-over-year basis. So, hey, if you can increase your marketing $4 million, but you increase your gross profit over $11 million, we'll take that any day of the week. Thank you very much. Research and development, they brought that up a little bit, but not too much, right? R&D, always think about that as new products coming down the pipeline. Total operating expenses, $38 million versus $35 million, which is an increase, but it's not that much of an increase compared to gross profit, right? If we look at other income, they had a small amount of other income versus a big loss in the same quarter last year, right? So net income actually went positive for the company. And a lot of people were not expecting any sort of positive net incomes for Honest really until next year, right? We were expecting positive adjusted EBITDAs, but as far as a bottom line, like a true gap, net income positive. No one was expecting that this year. People are thinking maybe next year or maybe 2026. So the fact that we're already there in 2024 means the business is trending way better. And the management team, led by obviously Carla there, is doing way better than expected. Kate Barton and all those folks, right? So the moral of this story is Honest's business model is way better. And I mean way better than we had anticipated, right? Now, check this out. I thought this was very, very important. If you look at adjusted EBITDA here, right? So stock-based compensation, this counts as an expense, right, for the company. But it's a non-cash expense when it comes to stock-based compensation, right? They had $2.1 million of that. So they were actually more profitable than maybe it looked, right? But that also was down from $3.7 million at the same quarter last year. They have the securities litigation expense that's been some sort of issue for the company on the legal front this year, but it looks like it's likely not going to be an issue for the company next year in 2025, from at least what it sounds like. There's no guarantees there, but from at least what it sounds like, it's an issue this year, not an issue at next year. So that should roll off for 2025 as well. So you have a non-cash expense there, and you have a one-off-ish. So their adjusted EBITDA was actually $7 million in the positive versus $1 million in the negative for the same quarter last year, right? So the moral of the story is be ready for that net income to likely increase considerably next year. I mean considerably. You're looking at a company that just is starting to get to profitability, but you should see the profitability increase be quite dramatic in 2025 and 2026 because it's going to be a multi-year play out here. Okay. Now, if you're wondering why the stock price is up so insane after it's been up so insane, it's even outperforming Palantir and NVIDIA over the last year. Here's why. A year and a half ago, let's call it that. 12, 18 months ago, there was a big debate that maybe Honest could go bankrupt. And the reason being is their losses were huge. They were running their cash balance down low, and people thought maybe they're not going to make it. And that's why that stock got all the way down to $1 a share, right? It's tough times. Carla brought herself and the team in, right? Jessica Alba left the company. And ever since then, I mean, the numbers have been nothing but extraordinary. This is one of the best turnarounds I've ever seen in my life. One of the best turnarounds. Like, if you look at where Honest's margins were at this point last year, I'm talking gross margin, I'm talking bottom line net margin. They were in the dumpster. And how fast her and the team have brought those gross margins and those net margins back is nothing short of historic. Additionally, the revenues have increased so considerably, right? I mean, we're talking about now a very nice double-digit revenue grower on the top line, which is incredible. Like, a lot of people didn't think that was possible. So now we're looking at a company that's growing revenues double digits, right? And I wouldn't be surprised. Like, there's no reason for me not to believe they can't grow double digits next year, seeing what they've been putting together this year for revenue, right? We're talking about gross margins likely headed to 40% plus. 40% plus. And remember, they're in two big categories for them, or low margin businesses, relatively speaking: diapers and wipes, right? That's usually lower margin businesses. So they've got that holding them back. But my guess is that the beauty business is going to start continuing to bring up those margins as well. So we're talking about a company that's likely heading to gross margins 40 plus percent. 40 plus percent. So now the question is, where are we talking about net margins going? And that could be the next debate here, right? And so, when I look at Honest, the other thing you've got to consider is this is very, very important here, okay? Look at the balance sheet. They're now sitting on $53 million in cash and cash equivalents. So now the company has so much cash around, right? And they have no debt on the balance sheet either, right? Look at the balance sheet. It's a grade A balance sheet. And it's incredible considering this is a small cap company, right? $133 million in total stockholder equity, no debt, 53 mil plus in cash and cash equivalents. Now what they could do, listen, you can still get 4% plus on treasuries. Or the 5% are pretty much gone now, but the 4% range in treasuries, you can still get that. For 2025, Carla and the team should put a good chunk of this cash into, guess what? 1-year treasuries or 6-month treasuries, right? If they do that, they're likely going to be able to make crazy other income for the company, right? This is a considerable, they could easily put, in my opinion, $25 to $35 million in treasuries. If they want to go 3-month treasuries and just have those roll over, or 2-month treasuries, whatever they want to do, right? Or if they really want to lock it in for 6 months or 12 months, they can do that. But you can get 4% plus. So run the numbers, run the math on that, right? it's not like it's a small amount of money given that Honest is a company that's still at infant stage of profitability, right? So this could make their profitability go much, much higher on a GAAP basis here, really over this next, 1 to 2 years, if they choose to do that. And if I was them, I would absolutely. It's free money. You got this money just chilling around. You're not doing anything with it, and it just keeps building. And if the company's getting to true profitability now, like the money's just going to keep stacking. Next thing you know, they're going to be at 60 million, 70 million, 80 million, $100 million of cash and cash equivalents. Let's park a good amount of that in treasuries. Let's get that yield pouring in. And talk about another level here, right? And additionally, if you're talking about another thing that took bankruptcy off the table, one is if you get to profitability, that takes it off the table. Additionally, cash and cash equivalents, 53 mil with no debt. The company's good now. They're good. They can make it through whatever storm they got to make it through if they even have any storms to come, right? Now, if we're talking about the stock price and does the stock price still have room to move for the upside here, the answer is absolutely. Go ahead and take a peek at trailing 12-month price to sales ratios, and this compares them versus we're comparing them versus Procter and Gamble here and Kimberly-Clark. And what you're going to see is Honest is in the 1 range, right? Procter and Gamble's in the 4 range, and Kimberly-Clark's in the the low 2s. So Honest likely could easily double from here. Go from a $6 stock to a $12 stock to kind of put it in the price to sales ratio of at least kind of in the Kimberly-Clark range, right? But keep in mind, Honest has much more growth than Kimberly-Clark, so they should actually command a premium over them. So my view is the stock could easily double from here over the next year. As long as Carla and the team keeps putting up this sort of improvements and this sort of numbers, there's no reason why at this point next year, Honest couldn't be a double-digit stock, right? $10, $15 a share, somewhere in that range. And then if we're talking about that bottom line continues to increase rapidly, right, we could be talking about the price to sales ratio eventually getting to a place where Procter & Gamble is, which by that time, Honest is then a $20, $30 stock from $6 here today. So the moral of the story in regards to Honest is it's been a game-changing stock for anybody that was buying at this time last year, right? But there's still likely a lot of gains coming. This stock's likely headed to double digits, meaning $10 to $15. And then if they keep this going into 2026, the stock is likely headed then to $20 to $30 range at that point in time, right? So the moral of the story is in regards to Honest, things are looking dang good. And I'm just thankful. I'm just thankful because this looked like it could have gone bad. I've got 50,000 shares in my main private account, 50,000 shares. And then I have other smaller positions in a couple other portfolios as well. And this is one that it was looking bad, man. Go back 12, 18 months ago, it was a real maybe they aren't going to make it, right? And man, they made it. They made it, and it's becoming a lot more fun now. Alrighty, let's get into these videos.
It's because they beat the Q3 revenue estimates. Earnings says they beat everything and using AI to attract new customers. But really, this may be a renaissance period in terms of just entrepreneurship. So joining us first on CNBC is Harley Finkelstein, Shopify's president. Harley, first of all, congratulations. You did confound people. The last quarter, you told us you were spending out of strength. I believed you. People thought you were spending out of weakness. Completely wrong. How much did it help that you guys have really turned on the jets here?
Yeah, I think what you're seeing, Jim, is that we continue to deliver some of the strongest results in the industry quarter after quarter. If you look at our sort of key metrics, GMV, which is, of course, the sales by our merchants, a proxy for how merchants are doing, was up 24% to 69 billion. Our revenue was up 26%, but also gross profit grew 24%. Operating income more than doubled from last year, and free cash flow margin expanded to 19%. So what you're seeing is we're able to deliver both on growth and on margins, and we're gaining shares in a very vast and a very thriving market, and it's working.
Now, I do believe that you have come out with a thesis about what's going on right now that I just love. You have lowered the cost of failure rather dramatically. So people who can take side hustles, make into the real deal. The passionate people are able to take your site and go soup to nuts. It's working.
That's right. And what you're actually seeing is more merchants are coming to Shopify across verticals, industries, geographies, and size. So while we're the place to start a small business, someone that has an idea in the shower decides to get it started, we are the default place to do so. At the same place, we're seeing companies like Reebok, Off-White, Hanes, On Running, Victoria's Secret also come to Shopify. And ultimately, the key to this is making it really easy to get started. And I
love that. Shopify's really, and this is the biggest position I have in the public account. I love that Shopify is that company that can be there for the small business owner, the one that's just getting started rolling, right? Or the one with a few employees. And they can also be there for the large companies, the mid-sized companies, and everything like that, right? I was just looking at Shopify stock over the past year. It's been a tremendous performer. The problem is if you compare it versus NVIDIA and Palantir and Honest, right? It looks like, oh, it's not that much. That's insane. 84% in a year? Like, that's insane. Like literally, if you could tell me I could invest in stock and make 84% in a year for the next many years, I'll put all my money in it. Like, if it was a guaranteed thing, right? That's insane return. So, yeah. It doesn't look that much compared to Honest and those stocks, but I'm like, that's an incredible return.
Scale, you have everything you need to future-proof your business. When you think about the scale we have now with millions of stores on the platform doing $69 billion, we're also able to supplement that with incredible merchant solutions, whether it's payments or it's capital or our financial services. And so we're effectively creating this unified retail operating system, and it's working really well.
Let's talk about the finance. On October,
when it comes to Shopify's stock, something they're going to definitely benefit from as this company gets bigger and bigger and bigger. With Shopify's market cap right now, let me see where Shopify's market cap's at here on 1000X. Let's go ahead and go to search. I'm guessing it's around 150-ish billion, somewhere around there roughly. Yeah, around $150 billion market cap roughly, right, for Shopify. So as Shopify gets bigger and as they reach a $200 billion market cap and a $300 billion market cap, something they're going to start to benefit from on the stock price front is they're going to become a bigger and bigger weight in the Qs and a bigger and bigger weight in the S&P 500. So as those ETFs are forced to buy every single week with people's retirement funds and things like that, right, more and more money is going to come into Shopify stock. Even if it's people that aren't active investors like myself that are saying, oh, I love Shopify stock, it's a great opportunity, I'm going to buy the shares. It's just going to be more and more forced money in as the market cap gets bigger and bigger and it climbs to $200 billion, $300 billion, $400 billion, right? I think long term, Shopify could be $1 trillion market cap, but that's, if we're looking out maybe 10 years from now or so.
just literally 14 days ago, you announced Shopify Finance, which I thought was brilliant. Are people already taking up on that one?
It's really cool. I mean, one of the things that we think is important about finances is making it really easy. So it's a new, intuitive, unified home for all our financial solutions. And it's built right into the admin. So whether it's access to balance or credit or capital or bill pay or tax, it's one place you can go to get everything you need. Now, this is similar to what we're doing with AI, for example. We're trying to make sure that merchants on Shopify have an unfair advantage so that if it's things like product photography, AI makes that better. If it's responding to emails from customers, AI makes that better. So rather than looking at AI as one single part of Shopify, it's embedded across all of Shopify. And we take that same approach to all of our tools, which is why people come to our platform and they never leave.
All right, so let's talk about a recent slide that was in a Salesforce document, a deck, so to speak, about why customers trust Commerce Cloud. They're talking about how they have won business from you, Hasbro, Black Rifle, Reserve Bar, Pokemon, Solo Store. How do you respond to a Mark Benioff saying, listen, we think that these guys are terrific, but we are winning share?
Yeah, I mean, we're not seeing that. We're seeing the opposite. We see on a consistent basis, some of the largest brands are coming onto Shopify. You know, this quarter alone, 16 enterprise brands launched on Shopify. So yeah, we love our roster of homegrown stories, Gymshark, Viore, Mattel, but we also like the fact that MeUndies and Vera Bradley and these, much larger brands are coming to us also. Look, we're not trying to do everything to everyone. We do one thing and we do it better than anyone, which is commerce, retail. And what we're seeing is that what these big brands are looking for is one place to sell, not just online, but also offline across social media on places like YouTube. We announced a partnership with Roblox, where now Shopify is powering commerce there as well. This idea of creating a unified operating system for all of commerce is the reason why these big brands love us.
I think
that was a great response. That was a great response. He got put into a place where he had to be defensive there. Great response.
Your stock can go up so much is people still don't understand what you do. And that's because, as you say, and Toby says in the great video about how we're not trying to be your company. We're trying to be behind your company, which is a level of modesty that I greatly appreciate. For instance, if you wanted to start a product and need to be distributed, you guys have a relationship with Flexport. Make it so that basically we take the taxes out, you ship, you don't have to worry about your warehouse, you handle everything. I don't think people understand the complexity of what you're offering because it seems so simple.
Think about this. If you were to pretend that Shopify was a single retailer, you aggregate all our stores, let's just say in the US alone, we'd be the second largest online retailer in America. Now, why does that matter? It matters because when we negotiate rates for things like shipping or payments, we are negotiating as if we're the second largest retailer. And instead of keeping those economies of scale for ourselves, we're able to disseminate them and distribute them to everyone that uses Shopify. That is how you bend the curve.
Like
that is how you level
Love
the
that.
playing field so that everyone can be successful faster. And that's something that is unique to Shopify.
I love that.
Well, I've got to tell you, I like to refer to the fact that you're
That does give them a huge moat, 100%.
getting killed when you're on last. You said, look, it's really a great opportunity. The people who were negative, they were dead wrong, Harley. I hope they were shorted, and now they have to figure out what to do. Because I know what to do. Go buy your stock. Thank you, Harley Finkelstein, for coming on.
Thank you, Jim. Thanks as always.
Yeah, so is Shopify stock still a buy? The answer to that is absolutely. Shopify stock's always a buy. Like, any major dips you get, corrections, crashes, be thankful. That's all you got to do. Be thankful and buy. When it comes to Shopify, same thing with Amazon. Over the past 20 plus years, every dip in Amazon's been a buying opportunity. Every last dip. And Amazon's still a buy to this day. Right? Amazon's still a buy to this day. Every dip you get, you buy. Shopify, same exact thing. Right? And so when it comes to Shopify, that stock went all the way down to $25 in that 2022 crash, right? Absolutely epic crash from 180, 150 all the way down to $25. And obviously since then, we see what's happened, right? The stock's trading, 110 plus now? 115. What a move from $25 back in 2022. And that's why, guys, always make sure you take advantage of those crashes, those major corrections in the future. Like, just keep in mind, those don't come around often. Make sure you take advantage. You see the Nasdaq go down 35% plus like we saw in 2022, you better freaking be buying like crazy. If you see the Nasdaq even go down more than 10%, you better be buying like crazy. Never mind if you get a 20, 30, 40% drop, 50% drop, you better buy every freaking share in sight. And always remember that to the future, right? Because I know there's a lot of people that had a great opportunity and they could have been buying these stocks back in 2022 when they were crashing like crazy. And they chose not to. And that is frustrating because there was so much money to be made in these stocks. It was incredible, right? So you're going to get crashes in the future. You'll get major corrections in the future. It will happen. Don't be like the people that left the market and didn't decide to buy and all sorts of things. I called this back in 2022. I remember how many videos I did, and I called it and I said, watch, there's going to be a ton of people leave the market. They're not going to come back until the next time the market's hot, right? That's exactly what we saw play out. A lot of people left the market in 2022, and now they're finally coming back. And it's like, dude, like you can still make money, and there's still opportunities in this market, but I'm just like, you missed the easiest freaking money. Shopify from 25 to 100 was so easy. Is Shopify probably going to go from 115 to 200 something over the next few years? Yeah, sure. But the 25 to 100 move was where the biggest money was made. Meta's probably going to go from $600 roughly dollars where it is today, a little under 600, right? And it's probably going to move to $1,000 over the next few years. So there's money to be made there. But do you know how much money there was to be made if you were buying the stock at under $100 back in 2022 in the fourth quarter? And you got the 100 to 600 move? Like I did, like, damn. But it's just like, it's frustrating, man. People choose to not be in the market in those sorts of times. And I'm like, that's exactly when the life-changing money's made. There's still good money to be made in the market, but it's not life-changing money now, right? Unless you get into very special opportunities. Frustrating.
Agencies, some of which regulate his companies. For more, let's bring in CNBC's Steve Kovac. Also,
no, the other issue. The other issue.
Let's bring it.
The other issue is, then people say, well, there's good money to be made in the market, but not life-changing money. So I'll wait to not invest right now. I'll wait till the next crash. You're not going to have a clue what to do or what to buy in the next crash. You have no clue because you won't have experience. You need experience to know. To be able to look at Shopify when it was crashing like that and be like, this is a great opportunity. Here's why. You can put your full bull case together. You can run your valuation models. Here's a bear case. Here's a bull case. Here's a base case around this stock. For Meta, for all those stocks, right? And so in the next crash we have, whenever that ends up coming, right? If people that are inexperienced have no clue what to do. Like if you were inexperienced in 2022 and you were just getting in the market and you did want to buy that dip, a lot of people were buying like oil and gas stocks. And they've made no money over the last several years. They were buying a lot of the value and dividend stocks because those were the ones that were holding up well compared to the tech stocks. They had no clue. And I know because I was a newbie in the market at one point. I got in the market 08, 09, right? And guess what my first stocks I was buying? Walmart, Conagra Foods, Walgreens, like all these boring companies, right? Kimberly-Clark, when we looked at earlier, all these boring companies. And meanwhile, there was just other opportunities in the market that were like stocks that were 2xing, 3xing, 5xing, 10xing at the end of 2009. Like, from the trough of early 2009 through the end of 2009 and into 2010, there were stocks doubling, tripling, quadrupling, 5xing all over the place. I wasn't in those stocks when I was a beginner in the market. You know why? Because I didn't have experience. I didn't know where the best opportunities were. All I knew is the stock market was in a crash. I was looking to get involved in the market and I'm buying these stocks, right? Jeez. So yeah, that's another problem. People think, oh, there's not as much money to be made, so I just won't get started investing for a while. Okay. You will have no clue what to do in the next crash. You'll have no freaking clue. And then you're going to be like, oh, I bought some stupid stocks in that crash and I could have made life-changing money. Like, dude. Okay, so anyways, that's my advice to anybody that's more of a newer investor watching us right now. Or to anybody watching this that you didn't take advantage of that 2022 crash.
Steve Kovac. Also with us is Wedbush's Dan Ives, who mentions, Dan, that his influence at the White House you think will be a game changer for Tesla. And maybe we should start there with kind of the immediate kind of investable implications of all this. Some might say, hey, this is now a major distraction for Musk, but he's shown himself to have a pretty wide berth.
It's a poker move for the ages for Musk because autonomous now is going to get accelerated, I think, potentially 2 to 3 years. The AI, that's the key piece. For Tesla, I think that's worth $1 trillion alone. And when you look on the federal agency side, look, essentially, federal agencies were the teachers. Musk was the student. Say he was in detention. Now he becomes the principal. So as this all plays out now, it's a huge sort of seat at the table. And for Musk and Tesla, I view this as a game changer from unlocking value, but especially Musk's influence is not going to stop here. I expect more of it, especially when it comes to China and AI.
So let me just sort of stop you right there. So on the issue of autonomous and AI, this might be something involving NHTSA, the agency, for instance. He's talking about going in and trying to cut $2 trillion of federal spending. You're reading this as is somehow directly affecting what NHTSA might do on that front? I mean, just connect those dots for me.
I think there'll be a knock on the door for NHTSA, and it's Musk who's sitting there. And look, and ultimately, this is just the start. And I think, Kelly, that's what the stock's starting to reflect, is that the autonomous piece, which is really what I view as the key from an AI perspective for Tesla. That's why you really own it here, $1 trillion of value. Now that starts. That's get accelerated. And what you're going to see now, it's not just about autonomous. Even when it comes to China tariffs, I do believe there will be a Tesla carve out there along with Apple and some others.
Interesting.
So the point, anyone that thought Musk...
So for you don't see this really, or let's put it differently, whether or not Musk's real goal is...
It's interesting. He's got a $400 price target. That's actually not that far from where the stock's at right now, right? Interesting.
Government spending significantly. You think he has just a direct kind of intention when it comes to more quickly deploying the technology the companies work? Because it seems to a lot of us, and Steve, I'm curious if you're taking this, that they're still trying to get this technology ready for prime time.
I mean, to me, I think part of why it's not been prime time is because regulatory, it's been that spider web. This is going to accelerate that. And now, ultimately, when that knock comes and it's Musk, it changes the whole story for Tesla. And again, Musk goes from, he was iced out, right? He was from Biden administration. And now, ultimately, you're coming into his office.
Steve, that said, it's not a direct government role. It's an advisory role, which is why he doesn't have to divest anything.
That's a super important caveat here, is that this is an outside role. He is not going to be able to slash and burn directly in the way that he's maybe been saying he could do. $2 trillion aren't just going to be wiped off the map immediately. What can happen here is he can advise the president if there are some things that Trump, once he's in office, can do via executive order. Yes, that could happen. But we had the senator from Tennessee on Squawk Box this morning saying these are going to have to come to Congress. We're going to have to approve all these spending cuts. Remember the commission Obama put together in his first term about reducing the fiscal commission? That never went anywhere because the Congress did not have the appetite to do it. On the NHTSA front, that is also an important thing. He's been battling with NHTSA for a while over full self-driving, which is not full self-driving, by the way, that term that they keep using. It's an assistive driving feature. And also the technology is just not there. If you go to San Francisco right now, you can whip out your phone, Call Waymo. That's an
Exactly.
Alphabet company. It works. There's no driver there. It uses a different kind of technology than what Tesla's trying to do. Tesla is all about using cameras around the car and using artificial intelligence to interpret what's going on. That has not proven to be as good yet as LiDAR. It'll get there,
Waymo
but it's
is
not
using
there
LiDAR,
yet.
which
Waymo uses LiDAR and cameras.
LiDARs are more of
They're like radars.
The radar
those little
sensors.
spinny things you've seen on the top of the
It
cars.
boils down to being able to kind of see around the parked car if the kid's running
So
out.
maybe loosening up the regulations does help that kind of stuff. But keep in mind, part of the reason why these robo-taxi ambitions have not come to light yet, I mean, Musk has been talking about this for 6 or 7 years now, is because the technology isn't up to speed yet from some of these rivals.
I would just say to his point, great points. 5 years ago, they said Tesla was never going to really be profitable. Then they said never would get to 100, 200,000 deliveries a year. Now we're talking about 2 million. When it comes to robotaxis, it's a matter of when, not if. And I believe this gets accelerated, and that's why Musk, and you're seeing it in the stock, they have had issues. But the game changes now for Tesla, for Musk. And look, there will clearly be noise out there. How is he going to balance everything? As a Tesla investor, you want to see him more involved. He's going to have a strong seat at the table, a whisper, especially in that White House.
Quickly on the technological piece of this. So let's say the administration is a little bit more relaxed about the arrival of all of these technologies, would seem to benefit Waymo. There's a lot of implications maybe for Uber, some of the others down the line. I take it we're not going to allow Chinese autonomous driving in this country. But, Dan, does it actually heighten the competitive landscape for Tesla if, to Steve's point, this technology that they're deploying doesn't seem as effective as the Waymo on the market?
Well, I think on two sort of areas. One, EV tax credits are done, which is a huge gut punch for the Detroit, GM, Ford, and others. That ultimately negative for EV, positive for Tesla when it comes to scale and scope. Autonomous perspective, Waymo will benefit, I could say ultimately Uber and others, but they ultimately want to go down the path that we're seeing in China. China right now is speeding up autonomous, very well known in terms of what's happening. And that's why this will be a huge part of Musk in terms of going after AI and even on some of the Inflation Reduction Act stuff, more toward AI-driven spending, which benefits the hyperscalers, Palantir, and others.
Yeah.
That's why Musk having a seat at the table changes everything for big tech and for Tesla.
And it's not just...
Yeah, Tesla gave me another free trial for my Model S, the full self-driving, right? And, I tried it out quite a few times. It's good, but it's not great. And it's still a long way from being perfect. So if you go Waymo, Google's product, it's great. It's near perfect when it comes to that product, right? Might not be exactly perfect, but it's pretty dang close. And so for Tesla, we still got work to do. It's a good product, but it's not great yet. It's not good enough to have somebody, like, just as somebody that's experienced it many times now, it's not good enough yet to be able to drive people wherever you need them driven with nobody in that front seat. Because there's just weird situations that happen along the drive that you still have to end up, let's call it doing something about, right? So yeah, there's still more work to be done there. We've made tremendous progress. It's a very good product, but it's not great. So that's going to happen. And I think Dan Ives brings out great points. Tesla's been doubted many times before, and they always come through. And that's probably what's going to happen in regards to this situation. But the debate in my opinion is not, does Tesla get there? I think that's, like, in my opinion, like, for sure, like 99% they're going to get there. It's just a question of, do they get there 2025 in terms of making the product great, near perfect, right? Up to Waymo caliber. Is it 2025? Is it 2026? Is it 2027? My guess is they still need another year of data. That's my guess. In 2025 to then 2026 have the product be a great product where it's near perfect and you don't need somebody in that front seat. That's my guess in regards to that. So we'll see. But I think they need one more year of full data, and then we can talk about 2026 being at that point where we could actually, for real, have robo-taxis going all over the place and Teslas, being allowed in just state after state, city after city, and just kind of moving from there. All right, let's hear about Amazon here.
Trade today with your new tie.
is what?
I like this new tie.
You were very proud of it.
I really
Great.
do like it, but okay, that's just
Very
me.
proud of it.
I also like a name that name that Joe mentioned earlier, Amazon. He's a little mad at me. He says I stole this from him as a final trade. You should feel complimented that I agree with you.
Okay. Shan?
Industrials.
Yeah, so Amazon, as far as if we look at Amazon valuation here, let's go to projections on 1000X and let's type in Amazon and let's run some numbers and you can begin to understand why Amazon's still, just a tremendous opportunity. So Amazon around a $2.22 trillion market cap roughly, right? So we could run Amazon at like a 12% revenue growth rate. Obviously, that's considerably under what Amazon's been growing at over time. Now, as far as net income, that should grow much more rapidly than top line. I would probably say like a double up is a pretty safe assumption when it comes to that, which then puts net income margins at 13%. Keep in mind, you're going to see Amazon's margins likely increase dramatically over the next many years. And I'm talking about net margins specifically. And the reason being is it looks like Andy Jassy and the team's going to really keep costs down in regards to employee count. Additionally, what's happening is the two most meaningful businesses are becoming that advertising business, which is advertising straight profit, and Amazon Web Services, which is also extremely profitable compared to the e-commerce side of the business. So it's so funny, an Amazon Prime truck literally just pulling up in front of my house as I'm talking about Amazon. This is hilarious. So let's run Amazon, at like a 35% low end PE here, okay? We'll run it at a 35, which is pretty dang low for Amazon over time, and up to like a 55, which keep in mind, Amazon many times runs 50 plus in regards to PEs. And what you're going to see here is, we're talking about 19% CAGR on the low end, 33% on the high end here. Let's tame it down a little bit. Let's say 10% revenue growth, okay, 10% revenue growth, which would get them, I think they're going to be over $1 trillion. I think 2028 will be the first year they'll be over $1 trillion of revenue. And then let's run them at a 20% net income growth number here, and let's see what we get for our numbers here. So then we're at about a 15% CAGR if you're valuing at about a 35P, which once again for Amazon is very low, especially for a company growing 10% top line, 20% bottom line, and 29% CAGR on the high end, right? And then you say, what if Amazon gets back to some very nice growth over future years? Let's say the advertising business is booming, AWS is booming, and e-commerce is booming. Let's say consumer gets in a better spot. So let's say they do they get up to like a 28% net income growth per year, right? Which is definitely a real potential. And if they're growing at that, you're going to value them at least at 45 PE there. There's no way you're going to value them only at, not for Amazon, not for those sorts of growth rates, right? And we could say to like a 70 on the high end for Amazon, right? I mean, if they're growing 25% plus a year, bottom line, so then we're getting a CAGR of 30% plus on the low end and 46% on the high end. So, in several different scenarios, like Amazon's a buy across the board. It's just a question of how much money are you going to make in Amazon over the next 4 or 5 years. That's really the only, argument. Amazon, no doubt, is a moneymaker over the next 4 or 5 years. It's just a question, is the compounding annual growth rate like a 10%-ish number, 15%, 20%, 25%, 30%, 40%? That's the debate. And there also should be no debate if Amazon's going to outperform the S&P 500 over the next 4 or 5 years. Absolutely. Like if you told me I had to go all in Amazon or all in, the S&P 500, I'd feel much more comfortable being in Amazon, especially if I was from a frame of thought about getting the best return profile, because Amazon should significantly outperform the S&P 500 over the next 4 or 5 years. Okay. All right, let's get into this one now, trimming Microsoft, because I thought this would be an interesting discussion around selling stocks.
Since Election Day, but not everything. And by not everything, I don't mean things like staples or utilities. I mean things like Microsoft, for example, which is up, but only up 2% since the election. So that looks weak relative to some of the other gains that we've seen. I bring that up because you trimmed it.
Yep.
which I thought was a pretty interesting move. Why'd you do that?
Well, it's just clearly not the leader right now. And I'll extend that to say that the Mag 7 in general is not the leader right now. You can look at Apple as another name in that space. But I also want to say that the Mag 7 should no longer be looked at as a monolith that moves together. There are different forces. There's different business models in there. But just to go back to Microsoft specifically, I think at this point in time, everything that we think we're going to know about AI has to be priced in. This is a good, year and a half, 2 years since ChatGPT really hit the ground running. I'm sorry, about a year, a little over a year. At low 30s multiple, I think it's all priced in. And I'm not selling the name entirely because I think as the market goes up, something like this, which is a huge part of the overall market, is going to benefit from passive flows. But there are other areas of the markets that are working really well right now. And Shannon, you alluded to the broadening of the market. Think about industrials. Think about financials. Think about things that haven't worked as well, but probably will. And I'll put healthcare in that category.
You said that they're not going to, be viewed as a monolith anymore, but you spoke of them as the monolith when you say, well, AI is all priced in, because you could think that maybe it's priced in for Microsoft, but there are many suggestions that it's not priced in even to NVIDIA, which reports next week, right? So you can't have it both ways. If it's not going to trade like a monolith, then don't refer to everything as a monolith in terms of what's priced in and what's not, because there are standouts, ones that are still suggested to be that, and then ones that where, in fact, maybe some of it is priced in.
Yeah, so let me be clear. I don't think they're a monolith, both in terms of different businesses, okay, so that, for instance, Netflix is not the same business as Microsoft. But your point, I think, is excellently made.
Netflix is not one of the Mag 7s.
No.
Nor is it. Why'd you pick Netflix?
Okay, you want to pick Tesla?
Well, no, I'd like to pick one of the hyperscalers for AI. Let's talk apples and apples.
All right, you don't need a 2-on-1.
Let's talk apples and apples.
Okay, let's talk apples and apples. I will grant you, I think NVIDIA is fairly priced here, and I'm not trimming NVIDIA. I will also tell you I'm not trimming Alphabet right here, another AI name, because I think at the valuation, it's absolutely underpriced, and I think that's a name you can add to here. So if you want to stay within the AI space, absolutely, there are names that I think are not going to move symbolically with each other. I think Microsoft, and we've already seen it, right? We've already seen, look at NVIDIA versus Microsoft. They're not trading the same, and they're not going to trade the same. Look at Oracle versus Microsoft.
I think on through the end of the year is the one name
I love Amazon.
of the Mag 7 that will outperform.
Yeah, that's my prediction. There's still my prediction from like a month ago. But so here's how I would think. Like, let's say I owned Microsoft stock, which I don't. But let's say I owned it and I was trying to figure out, like, should I take some profits on Microsoft? Let's say I did really well over the last couple of years, right? I would kind of be thinking about valuation-wise. So Microsoft, this one's been growing EPS, in expected to grow EPS somewhere between the 12 and 17% range, in revenue around 14, 15%. So let's go ahead and run some projections on Microsoft, right? And we can begin to understand, first off, Microsoft, we got to think about the business model. Is the business model in any major disruption? I don't really see that, just to be quite frank. So let's run them at a 14% revenue growth, which is pretty high. I'm not sure they're going to be able to hit that over the coming years, but let's say they can, right? And they should always outgrow revenue in regards to EPS, so in net income. So I would say like 18% when it comes to net income growth, right? Now, since they're growing at those sorts of growth rates and it's SaaS, you're going to easily command a 30 to a 40 PE ratio. And that's easy peasy lemon squeezy, okay? So it's very fair. And you get a really attractive compound annual growth rate over the coming years, right? So let's tame it down a little bit. Let's take it down to 10% revenue growth, okay? Take it down to 10%. So this would be kind of a more of a bear scenario. Let's take this down to 14% here, okay? Take this down to 14%. And we'll keep the P's same, 30-40 range, right? Then you're talking about compounding annual growth rate on the low end, about 10%, on the high end, about 18%. And that's in more of a bear scenario, right? I like that. I actually think Microsoft's a fair buy here. I don't think it's the best buy in the stock market, but I think it's a fair buy. And if I held Microsoft stock, I would still feel very comfortable holding that stock, right? But that's how you really need to think about like if it's time to sell a stock or not. If you can run numbers several years out and you still get a very attractive compound annual growth rate, even in a little bit, let's call it more tame situation, a little less bearish or a little less bullish situation, it usually makes sense to hold those stocks. If it's not a very attractive return profile over the next 4 or 5 years in a base case or certainly in a bear case, then it just doesn't make sense to hold on to that stock. Okay. All right, guys, appreciate you joining me as always. Thanks so much for being here. Pin comment down there if you're looking to access all my premium courses: Become a Master Stock Market, Millionaire Playbook, Stock Options Mastery, Dividend Investing Mastery. If you're looking to get access to my private Discord chat, see the stocks I'm buying and selling, my $2.8 million plus Fidelity account now at this point in time. There will be a pinned comment down there. We're all booked out for this week, so we'd have to see about potentially getting you in maybe next week. Okay. Much love and have a great day.